months, 18 months down the line? Our answer is that in the near term, it is impossible to the predict the market. And we have always believed in that the market is impossible to predict, hardly any different than a coin flip. When people say it is difficult to predict the markets, they are mischaracterizing the problem, because you know being difficult is something which means that it still can be done, but impossible is something is that just cannot be done, because over the long term, and this is what the history of India also has been, that over the long term, uh, sorry, yeah, I'll just go to the relevant slide. Yeah, over the long term, I mean, this is true for India, this is true for US, this is true for any other big, large global market, is that markets have tended to deliver returns that are more or less in line with nominal GDP growth rate plus dividend yield. In India's case, nominal GDP growth rate has been around 12.5%. I hope all of you can see the chart here, that this is a 30-year period. So this encompasses two or three bull cycles, a couple of bear markets as well. So as you can see that over a period of time, over the last 30 years, uh, the nominal GDP growth of India has been around 12.5%, and the market, the Sensex, has also returned very close to that, in almost in line with that. And this is the case, not only in India but globally as well. And this nominal GDP growth rate basically follows the corporate top line and the corporate earnings growth rate, which is also around 12.5%, which in turn means that the market has also delivered more or less. If you look at an extended period of about 2 or 3 decades or even more, markets also tend to deliver around 12.5% over the medium term. But what makes India such an exciting market in the eyes of global investors is that it offers the highest alpha generation opportunity compared to any other bigger equity market. And by terms of alpha generation, I mean the amount of outperformance which you can get through stock selection. And while there are strong opportunities across the market cap spectrum, India has a very diverse and a large, mid and small cap segment, right? And which is relatively well researched, relatively less efficient, and which means that space provides a far higher degree of alpha generation potential. And many of the sectors which are seeing emerging right now, be it logistics or be it consumer durables, etc. Or the transportation sector, many of the stocks within these sectors are largely, mid cap / small cap sectors. Business models are heterogeneous, and there are many opportunities within these particular segments. So just going back to that, but having said that, we try to make sure that our portfolio at all times, reflects our team's bottom up stock selection skills. But we do try to keep ourselves abreast of the macro situation, and in that context, we will take you through a few charts which captures the macro situation now, capturing also some of the feedback which our foreign clients have been giving to us, because they look at markets from across Korea to Mexico to India to Turkey to Taiwan. So whatever the feedback they have been giving to us about their allocation in India, and broadly the three main themes or talking points which they are centering around, namely around earnings growth, around what is happening to China plus one, and also how India's macro or India's macroeconomic parameters fares versus the other geographies and other EM markets and economies, so as to say. But firstly, on the overall, corporate earnings. Now, if you look at this top chart, already I've explained, but if you look at this chart, corporate earnings growth rate has not come in a straight line, right? So there have been periods where they have grown at a very rapid clip. I just ignored this this 3-4 year period. But if you look at between FY3 to FY8, earnings have grown by about 25% CAGR. Over the last 3 years post-COVID, earnings growth has picked up again by around 20% CAGR. But there have been elongated phases where earnings growth have been subpar. So, for example, between FY 95, from 1995 to 2002, when we just had a 1% CAGR earnings growth, or from 2008 to 2019, which we often refer to as the lost decade for India's earnings growth, it was just at a subpar 4.5 to 5%. And this closely follows, corporate profits as percentage of GDP. Now, this has started to bounce back as we are speaking here. We still, FY23 numbers are still coming in, should be around 3.4, 3.5%, because remember FY22, we've seen very strong earnings growth. So it's still near about where the average is, but it has potential to scale up further, given that we are coming out of a deep bottom which was formed in FY18 and between FY18 to FY20, as you can see. Now, just coming to near-term trend in earnings trajectory, FY23, that is March 2023, we ended the earnings growth for Nifty at around 13%. So this, as you can, I'll just focus on this chart below. At around 13%. The next 2 years earnings estimates are expected to be around 15 to 16%. So far, based on 1Q FY24 earnings so far, there have been there has been hardly any downgrades to earnings. So earnings estimates remain steady. Most of the sectors are expected to post steady earnings growth. But if you look at this chart, one thing is clear that this was the lost decade, kind of the lost decade for India's earnings, plagued by various sectors not performing to their potential. But post COVID, we have seen a pickup in earnings growth. Now, this was obviously FY22, where it was the strongest phase of earnings growth post FY3, FY4. But even after FY22 as well, after March 22 as well, there were many disruptions, be it on the supply chain side, due to the Ukraine-Russia war, or higher crude oil prices, etc. But earnings trajectory has remained by and large flat to stable at around 13 to 15% earnings growth. So one can say that the next couple of years, one can expect, at least the consensus expectations is that earnings growth should reside somewhere between 13 to 15% on an average. And that has been the consensus expectations, even in the prior cycle as well. If you recollect, between FY15 to FY18-19, every year we started off with around 14-15% earnings growth expectations, and then somehow this earnings growth expectations got cut, and finally we would end the year with 4 to 5% earnings growth. But in this cycle, what seems to be different is that we are starting the year with 16-17% kind of earnings growth expectations, and ending the year close to 13-14% earnings growth, which means that earnings estimates are largely remaining stable despite many disruptions which we are seeing around us. And one of the key reasons, obviously, has been one sector which you are very well aware of is the banks. The earnings turnaround has been led by the cleanup of the balance sheets, and the Indian banking system is now at its the best health in terms of asset quality, and also in terms of its capitalization ratios. If you consider the last 10 years, the period overall. India's earnings growth has also been relatively more stable compared to its peers. Coming out of the crisis also, even in crisis years, what we 2008 during the global financial crisis, or calendar year 2015, during China crisis or calendar year 2020 during the COVID crisis. I mean, each of those years, India's earnings growth uh, fell a bit. Obviously, I mean, it contracted by 3, 4, 5%, but there was never a sharp contraction as compared to some of its other global peers, such as Taiwan or Brazil, because those markets typically, and we have the chart here, because those markets typically tend to be dominated by one or two sectors. So Taiwan, for example, has a very heavy reliance on the technology sector. So it's about 68% of Taiwanese index is dominated by technology stocks, of which 40% is because of TSMC. Right, so TSMC as a stock alone has a 40% weight in the index. But if you look at India, it's a very heterogeneous composition, very fair representation across sectors, which means that no one sector makes or breaks the earnings growth. So you have a relatively more stable profile of earnings as compared to some of the peers, and that is also what some of the foreign investors look at. And just coming to valuation, it is at it's close to, the valuations are right now close to its long-term average. Now, the long-term average, one can think of it as 17.2 times, which is the 30-year average. But what we've also plotted here is the last 10 years average, and this is very important because since the Modi government came in, valuations have re-rated for the Indian markets. As you can see that the earlier average was around 17.2, and post the Modi government, the average multiple, the 1 year forward PE has been around 20.7 times. Now we are around 19.6 times. This possibly could have gone up by a few points, as I said, because of the latest market rally, but we are more or less close to our long-term average in that sense. What investors also like to look at is where India is trading in terms of its other emerging market peers, and this has been a perennial debate that India always trades at a premium, and what is happening right now is that the premium expanded over the last so the premium expanded post 2021, and now it has subsided a bit, but it still remains above the one standard deviation mark. And the key reason because of this has been, and the key reason for this has been the derating of China. Because apart from India, the other big EM market is China, and China is down 25% in US dollar terms since the last 2 years, which means that it is the Indian markets de facto where the re-rating that's how it shows up in the P premium re-rating of the Indian markets. And post which there has been a rally in the other EM markets this year. India has performed more or less in line with the other EMs, and that's why, as you can see, that the premium has actually come down this year, but it still remains above its historical range. And one reason for this premium to have been the one particular reason why India has always traded at a premium compared to its peers is because of the fact that investors place a lot of emphasis on democracies, right? If you are to think of governance as a vector for looking at stocks, that how well governed a company is, a better governed company de facto, everything else equal, attracts a slightly higher P premium than a less well-governed company. In that sense, similarly, if you are to extend this analogy to markets as a whole, more democratic economies or more democratic markets tend to trade at a higher premium as compared to less democratic markets, and this has been the case across history, as we've shown here, and this has been one of the reasons why the Indian markets have always traded at a premium to the MSCI EM market in general, because India has obviously these are the reasons why there is a long-term phase for Indian equities. Economic evolution and strong domestically driven growth are very well known, very well analyzed in debates in CNBC, in media, etc. But the two things which are often less talked about. We've already spoken about the profitable and diverse corporate universe. But the other thing is that India has the institutional infrastructure of a mature democracy with an independent central bank, election commission, judiciary, and strong property rights under a common law system. So these are the reasons why the Indian market and why India tends to trade at a premium as compared to the rest of the other emerging markets. Now, having spoken about earnings and about valuations, the other big trend which our foreign investors, which our foreign clients are talking about, and which we are also observing from our portfolio companies, and this feeds into a lot of optimism around India, is the whole discussion on China plus one, and how India is emerging as a viable alternative for the manufacturing relocation away from China. So from a policy standpoint also, there is a clear thrust towards making India a manufacturing hub through initiatives such as Make in India. It is also complemented by very supportive policies such as production-linked incentive schemes. And all of it obviously comes at a critical time, given that COVID-19 and subsequent lockdowns in China have somehow forced global companies to rethink their supply chain strategies. And China plus one has been gaining traction, and India is emerging as a viable alternative. And mainly not only because and the main reason is that India is expected to have more than 900 million people in the age group of 20 to 60 years, which is the working age group, by over the next 20 years, right? So this provides not only abundant and cheap labor required for large-scale manufacturing, but also it enhances India's case as a domestic market, right? So so we are already seeing many of these shifts happening, and this is just one of the ways we've tried to capture this shift is that this is the slide. There's a very strong on-ground commitment for Make in India. So Apple, we all have seen in the news, they plan to shift 18% of their iPhone production to India, and about 25% of the total global production to India over the next few years. There is a very strong thrust towards other sectors as well. Specialty chemicals is one sector where we've seen Indian companies scale up significantly. There are other tech giants in diverse sectors such as aerospace to solar energy. You name any sector, the companies there are talking about what their India plans are. And in fact, when Prashant was here last week, we were speaking to a couple of companies and a couple of corporates as well, and according to them, in the late 1990s, if you look at it, corporate boardrooms worldwide were abuzz with discussions over what is going to be the China strategy for the next 2 decades, right? So they would always corporate boardrooms would always during the board meetings, etc., the CEOs would always be asked that what is going to be your China strategy, right? So that similar thing is playing out now, that today the corporate CEOs, etc., are being asked that what will be the India strategy for the next 2 decades, right? So one company which we already spoke about, Apple, that is betting big on India with plans to gradually shift about 18% of their iPhone production. And this is the left hand chart shows about the electronic exports to India, how it has grown at a very healthy clip, very strong growth of CAGR of about 25% over the last 6-7 years. But if one looks at Apple's 15-year journey in India, it started from an ecosystem. It started from a position where it was just selling, importing 3G iPhones now, to creating an entire ecosystem of not only manufacturing, assembly, but also opening its own retail stores as well. Right. So, Apple, in fact, became the first company to export smartphones worth $1 billion in a single month from India. That happened earlier this year. So there's a very strong traction which we are seeing in electronic exports, and obviously, the PLI scheme has worked for this sector, and this offers confidence that other sectors which were so far import dependent can also scale up domestically, right? Foxconn, in just a couple of days back, in like Business Standard, Foxconn has said that the third largest labor force outside of China and Taiwan would be in India over the next 2 years or so. So many of these companies are rethinking their India strategy. They don't only want to serve India from outside India, from a regional hub in China or Singapore or in Taiwan, but they want to be in India. They want to manufacturing in India for the Indian consumer, because the Indian consumer market has also now become large and viable for them to begin manufacturing. So this is one big change which we are seeing across the board. There is a lot of positive discussions on India as far as corporate boardrooms are concerned, and there is genuine traction as well. It's not only about plans, but also about putting up hard assets on the ground, and there too across sectors, many of the companies have very strong commitments for India. The third aspect, which our foreign investors often, which our foreign clients often talk about or compare India to, is on the macros, obviously, and that remains a talking point as always. And just from the macros, I'd just like to highlight a couple of things. Is that India's macro environment right now, as we see it, the latest CPI inflation print notwithstanding, because it did show some. It did show some volatility over the last couple of months, but the latest print notwithstanding, India's CPI has been more or less contained compared to its own history as well. Between 2000, if you compare its long-term history, and also within the central bank's tolerance band of 2 to 6%. So that is the RBI's tolerance band. So over the last 3-4 years, even post-COVID as well, it has gone a bit up, come down a bit, but by and large, it has remained within that tolerance band. Similar thing cannot be said about inflation in some of the other geographies, obviously, especially the developed markets where inflation has shot up to 7-8%, so on. So there is a lot of macro stability as far as these macro variables are actually concerned. Last year we saw crude oil prices go up to almost $120 per barrel. But the important thing to note here is that the evolving dynamics of the external sector as far as India is concerned. So what we've seen is that over the last few years, growing software exports and narrowing of the non-oil trade deficit has actually reduced India's vulnerability to higher crude oil prices, right? And initiatives like production-linked incentive scheme are likely to further the import dependency for the manufacturing sector. So just have a look at this chart here, and this is basically the level. The dotted line which you see corresponds to the level of oil prices, which leads to a 2% current account deficit to GDP, right? So in 2011, 2012, let's say a decade back, this was at $60 per barrel. So if oil prices exceeded $60 per barrel, your CAD would also exceed 2% of the GDP. This is the way to read the chart. Now, this tolerance limit over the years has gone back, which means that uh, you know it has come close to about 85 to $90 per barrel. So till $90 per barrel oil price at an average for the year, one can expect a 2% CAD to GDP. Currently, it's hovering around 80-85. Last year, the average was around close to $95 per barrel. So the vulnerability of macro variables, right, to higher oil prices have also come down. And one of the reasons have been that we have a very strong leverage to IT exports, and IT exports also have increased significantly over the last few years. Indian IT companies have been gaining market share. Well, there will be ups and downs in this journey, as we've seen over the last couple of quarters, where there has been some slowdown as far as new order inflows for Indian IT companies are actually concerned. But by and large, if you see through the cycles, Indian IT companies have been gaining market share globally. There's a very strong thrust towards services exports, while all of us speak about manufacturing exports. But India has demonstrated its growing leadership in services exports, and this is evident through almost $200 billion plus IT exports, which is happening annually, and which acts as a very fine counterbalance to the threat of rising oil imports. Right, so this is how we look at the macro variables right now. So we've spoken about inflation, we've spoken about trade, external sector, we've spoken about earnings growth, and we've also spoken about PLI. So PLI and also the manufacturing sector and China plus one. So these are the topics which we've touched upon. I think I've come to the end of my prepared comments, because I think I've spoken for about half an hour or so. I leave the floor open to Q&A right now. I'll just leave the floor open to Q&A right now, because there we can take questions on our portfolio positioning based on these and other topics as well.
Before we get the questions, a couple of questions come from my side. One is like, whenever interest rates are in the elevated levels, so when you expect some kind of interest rate cut going forward, and if we stay in those elevated levels, which are the sectors which is going to impact, which is any sectors is going to get a positive impact or negative impact, because we are the interest rates in the elevated level. Second question is like you mentioned about for the FY25, the earnings expected is in the range of 14 to 15%. So apart from banks, which are the sectors which will be contributing to this majorly? And those are the two questions from my side.
Sure, sir. Sure. So I think I'll take your second question first, because the first question will require a slightly more nuanced answer, given how we think about portfolio construction basis or philosophy, process, etc. So I'll take your second question first, which is more easy and direct, which is that apart from banks, the other few sectors where we are seeing a lot of traction is obviously autos, and that is expected to show very stable earnings growth. Industrials, that is another segment which is expected to show very stable earnings growth. We have seen some bit of moderation within the consumer companies in the near term, as far as, again, I'm caveating that in the near term, as far as top line growth is concerned. And healthcare is another segment where we are seeing very strong traction in earnings growth. So apart from financials, obviously the answers would be autos, some bit of consumer discretionary, industrials, and obviously healthcare.
So when you spoke about automobiles, now if you see the Indian manufacturers, mainly Maruti, Tata and Mahindra, they are having more market share now compared to the earlier days. So now the foreign players are slowly moving out of India. Also, their market share is coming down also. So where do you see even the EV space also, considering where do you see our automobile sector going for next 3 to 5 years?
Yeah, see, as far as
EVs, Indian auto. especially the Indian automobile side, like the key players?
Yes, yes. So see, the key players, if you look at it from an automobile perspective, is M&M, like Tata Motors and Maruti, obviously, right? I mean, from an OEM perspective, if you see that, I mean, the listed space, large OEM listed space, apart from two-wheelers. Obviously, in two-wheelers, you have a whole chain of players who are there, and plus you have an entire auto ancillary space as well. So Eicher Motors is something which is obviously there within the two-wheeler space. Within the four-wheeler space, as I said, you're having Maruti, Tata Motors, and M&M. So it's a very large, diverse sector. Once again, there have been investments in EVs across the value chain. There are component suppliers now. But yes, where India is right now in the adoption of the EV cycle is far away from where other economies are right now, especially if you take in comparison to China. So we will still take some time to catch up with that, and a lot depends on the infra creation around EV as well, which many companies are working towards. There are new other exciting technologies coming up, such as hydrogen, etc. So there is this whole paradigm to think about it. But Indian companies have been generally fast at adoption. That's what one can understand from the previous history, obviously, but obviously not at this scale. But do they have the technological capability and the ability to do so? Yes, certainly they do. Which means that as and when these transitions happen, India is still some bit behind, as I said, some of the other major markets like China, etc. But that is an adoption which is slowly happening, and although right now it's still in its early phases, and a lot depends on as I said, the infra creation across the country, and not only the big cities of India, such as in Delhi or Bangalore, but also even along the highways, etc. What kind of infra is created for these EV vehicles, and a lot depends on that. Yeah. So that was in the auto sector. I think that the other part is that which you asked on how we think about interest rates, right? That's a very interesting question, because we've written an entire newsletter on it. So this was Prashant himself says that this is one of his first newsletters which he actually wrote about, and this was just post COVID, right, when we were coming out of COVID, and 2020, as you know. So 2020 refers to a perfect is the futility of predicting investment returns based on macroeconomic worries and events. The first lesson was that the usual perennial macroeconomic worries of the well-known unknown variety are a colossal waste of time, right? So let me allow you to explain a little bit what we mean by well-known unknown variety. So well-known unknown varieties are, if you are to take a step back, and if you are to put yourself about 4 years back, right, January 2020, if someone were to ask you that what is the main macroeconomic worry which the markets will face, at that point in time you would have said that, well, the main macroeconomic worry for me would be whether GDP growth is going to be 7% or 5%, because the consensus expectation was 6%. So whether it's going to be 7%, whether it's going to be 5%. The other worry would be that whether Fed would stop hiking, because Fed was just about to close down its hiking. So whether Fed would again start hiking, or what is the outlook on the US Fed cycle? What is the outlook on RBI's interest rate cycle? And in fact, if you look at it, these have been perennial worries at the beginning of every market, like every year. If you want to go back and look at history, I mean, whether Fed is going to hike interest rates or not, whether RBI is going to hike interest rates or not, following the Fed, or whether RBI is going to run a counter-cyclical monetary policy or not. So these are things which are impossible to predict, and while our portfolio construction process is that we always run a very balanced portfolio, which means that we try to uh, uh, we try to position our portfolio in a way that, sorry, yeah, that we avoid any top-down misadventures. That is, we avoid any top-down calls on the market, such as the rupee is going to depreciate or the rupee is going to appreciate. So let's go all out overweight on IT or underweight on IT, or the rupees or the interest rates are going to go up or going to come down. So let's go overweight, underweight the banking sector. So we view macros as a source of random risk and not as an opportunity to add alpha. And that is why we stay fully invested and we maintain a balanced portfolio construction approach at all times, where we have representation from stocks across sectors, so that we make sure that we avoid any top-down misadventures or such as market timing or sector rotation, etc. But having said that, if you look at our banking portfolio, or if you look at how we are thinking of some of these sectors which are exposed to higher interest rates right now, so we believe that well, from a NIM perspective, maybe if you look at the last 2 to 3 years, last 1 year specifically, the banking sector has had a very strong run. If you look at on all three fronts, credit growth, NIMs, as well as credit costs, right? So all these three have been at its peak in a purple patch for the banks. NIMs have been improving, credit growth has been accelerating, and credit costs have been coming down. Now, what we've seen so far, in at least from the first quarter, is that maybe quarter to quarter there is some moderation. Q on Q, there's some moderation in NIMs, obviously, but credit growth still remains very good, and credit costs are also moderating. So so there is no risk as far as rising NPAs are concerned. So in that case, the banking sector looks very well insulated from any interest rate risks, so as to say, as compared to the previous cycle, where where it was already burdened with very high credit costs and already a rising NPA cycle. And the other thing is that corporates, if you look at it, corporates have delivered as well significantly. And this is what I wanted to show, is that the corporate leverage is also at its lowest, right? So if you are to think of it, if you're looking at an interest rate hike in this cycle between 2014 to 2016, obviously, the corporate leverage was quite high at that point in time. But vis-a-vis, looking at a rate hike cycle here right now, where corporate leverage is at 15-year lows, this gives you a feeling that corporates are in a better shape in this current cycle compared to possibly the previous cycle, which we'd seen about 5-6 years back. Yeah.
One question is basically what Albert was talking, and now we have a couple of days back there was a statement from Powell saying that it's not going to be only one rate hike, there are multiple rate hikes are going to be there, and most of the fund managers are talking about a rate correction probably after only one rate hike happening from Powell. So the message is that it's going to be at an elevated level, and our food inflation is also at a hike. So on the rate side, what do you feel furthermore it can go up rather than getting corrected? What was Albert's question? The second question is, every fund manager is talking about Foxconn and Apple, but at the same point of time, they are also talking about China plus one story. Is there any other industry where actually the seedings have happened? Because technically for, or whatever you call it, for the cell phone industry, it has been there for a very long time that they have done it, and they have today come to a very sizable stage. It's a 5-6 years back, or probably slightly more than that, the investment was started, and therefore it has happened. Everybody talks about the Apple and this, but they talk about China plus one, because you people will be meeting industries, as you also said at the initial, lot of international investors and CEO who are talking about India strategy. Is any other industry other than the telecom where there has been a reasonable progress, a couple of industries or any industry where there has been a reasonable progress, which actually gives you a much more firm view that yes, it is China plus one story which is coming up. So these are the two questions from my side.
Sure, sir. No, sir. So thank you so much for asking these two questions. Obviously, yes. Apart from the telecom part, which you said, apart from the communications, because Apple makes for very strong headlines. But apart from that, also across sectors, across segments, we are seeing some bits of the China plus one story play out. And I'll name a couple of sectors. If I miss out any, then I'll request my colleague Ankesh also to jump in here. But apart from communications, apart from electronics, apart from smartphones, we are seeing very significant traction in consumer durables, in other consumer durable industries. We are seeing in our cap goods companies, because now we hold about 6 to 7 cap goods companies, and in each of these calls, each of the earnings calls, the local management has highlighted that how the global management is now thinking about exporting or producing more from their India plants, and each of them have announced capacity expansions over the last year or so, or in the process of expanding their capacity. Auto companies, Anks, for example, they are also announcing, or they have also seen very sharp increase in their order books from their global parent as well. So I think it's more or less all these MNC companies where we are seeing this play out across sectors in manufacturing, autos, cap goods. Another sector where we have already seen some part of it play out, and India already gained market share over the last decade or so, has been specialty chemicals. Now, specialty chemicals is one sector where the China plus one shift happened much before China plus one became a buzzword, right? So that started to happen in 2015, 2016 when China started to tighten its own pollution norms, etc. And people were looking for a more viable, and large corporations were looking for a more viable, someone like a Bayer or even a bigger player like a Monsanto were looking for more viable alternatives, and that's when they figured or zeroed in on some of the India companies like Norwin Fluorine, etc., who have gained very strong market share across the segments in which they operate. Just to caveat here, one point is that, sir, in many of these segments or many of these opportunity sets which we've spoken about, India still has a market share of 1 or 2%. Now, China's market share in that context is about 16 to 20% across many of these segments. So, which means that even an incremental 1 to 2% market share gain away from China could mean a 15-16% year-on-year dollar growth for India over the next few years. So that's a very compelling story. We are, as I said, seeing it play out in quite a few sectors. But I just request Ankesh here if he has anything to add on any of the other sectors here.
Thanks, Deepujan. So I would only add that when we see upgrade of manufacturing in India, we should see in terms of two aspects. One is as a replacement of imports, government is trying to promote a lot of manufacturing happening in India. So with the reason we see a lot of news coming out only from phone manufacturers is because electronics is the third largest item that is imported in India after oil and gold. So not only phones, it's laptops, servers, all these are also imported along with. So other than Apple, Foxconn, you would have heard the news of HP planning to start manufacturing heavy servers in India and so forth. Other than that, in terms of major industry, I would say localization of defense manufacturing, because we import a lot of defense equipment, and that is happening on a broader scale. So we hold some of the companies in our portfolio related to it. And So import substitution is one aspect. Second is expanding the exports that are happening from India. So Deepojal mentioned specialty chemicals and auto parts have been going on for some time. Other than IT and pharmaceuticals, we are seeing a lot of capital goods that have started to being exported out of India. So that has provided a bit of a stabilization to the currency or current account deficit as well. So previously, if you would have seen, other than IT services and pharmaceuticals, things like gems, jewelry, textiles, these constituted most of the Indian exports. And these items, the demand for these items get hampered when suddenly prices move up or outside demand goes down. So they are quite price elastic. But now you see in the export basket, capital goods, auto parts, machineries, even in terms of services, a lot of business consultancy, engineering services are being provided. So that has kind of expanded the export basket for India in terms of more price inelastic items whose demand remains consistent. You get a lot of forex reserves on the basis of that. So in terms of other industry, things will happen slowly. Take semiconductors for example. Micron is one of the companies that announced setting up of semiconductor manufacturing in India, has committed a multi-million-dollar deal. But these industries are very high-tech. They take some time to get manufactured. You won't see suddenly an announcement coming up and next month the company getting a plant getting set up in India. It takes a bit of time, but a lot of positive progress is happening on that side. So initially you would see a lot of small and mid-cap companies which are suppliers, they getting the benefit, but later on the bigger companies start coming in and directly manufacturing.
I just had a query in terms of your allocations to various sectors. So we are seeing a consistent allocation towards the diagnostic space, and we have seen that the volumes as well as have not picked up in the non-COVID space over there. However, and the price also of the stocks have not moved anywhere, or in fact is in a downward trajectory. So given the competitive intensity in the segment, are we likely to continue to maintain exposure in the diagnostic space?
Yeah, so diagnostics, so if I look at my PMS portfolio right now, sir, so diagnostic space, Dr. Lal and Metropolis, these are the two stocks which we have, and these two combined about 1%. Now, if we look at our overall healthcare portfolio, we would have around we would have around 10% or so weight in that, plus minus 1 or 2%, and within that, we have a very diverse range of holdings, right? We have Abbott India, which is a pharma company focused on India. We have Rainbow Children's Medicare, which has done very well for us. We bought it close to the IPO. So that is around 1.5%, 1.6% of the portfolio. Cipla, which is having a very strong generics portfolio as well as a very strong India portfolio, and Ajanta Pharma. And of course, recently during the IPO, we had bought Mankind Pharma as well. So these are the 4-5 key core pharma stocks which we hold. Apart from that, as I said, we hold 2 hospital stocks. One is Rainbow Children's Medicare. The other is Krishna Institute of Medical Sciences. Again, Krishna was a recent addition. Within the diagnostic space, specifically, if you are to ask about 2 stocks, then Dr. Lal and Metropolis, this space has suffered from competitive pressures over the last year, and that is why you've seen the sharp correction in price of these stocks. But we have interacted extensively with the managements of these stocks, and the thing is that we also have a very strong healthcare team, right? And so we've interacted with a lot of global companies as well in this particular regard. So India is still at a very early adoption as far as diagnostics and diagnostic testing is concerned compared to some of the other countries. And much of this space is still not formalized. Dr. Lal is the largest player. Just that last year, due to certain disruptions, the stock prices got affected. But now, and also last year, if you remember, the year-on-year base came off, right? Because CY22, calendar year 2021 was the high point of the COVID testing, etc. So they enjoyed very strong margins as well. So in that sense, 2022 was a bit of a correction phase for them. But going into 2023, what we've seen is that so far, the operating performance has stabilized, and also the fact that some of the competitive pressures seem to be easing out a bit. So the predatory pricing, which we've seen from some of the new age entrants, are now beginning to subside. And each of these players have their own strong points. Dr. Lal Pathlabs is very strong in the north and towards east of India. Petropolis is very strong towards the west and south of India, and they have done a few acquisitions over the last couple of years, so which should help them to gain market share once the competitive pressures ease or stabilize over the next couple of quarters. And Dr. Lal Pathlab, if you've seen, has been one of our first holdings. So from that point in time, if you are to see, we are still quite a bit in the money right now.
Just to follow up on that, in a sense, I just wanted to understand the rationale, because most of the positives you mentioned in terms of the industry trajectory or the shift from the unorganized to organized and larger figures in this space. However, most of that is reflecting in the price to earning multiples. So do you believe that there could be further downgrades in terms of PE multiples, because the earnings are not growing as sharply as what markets were expecting, and it seems to be a longer period of consolidation before we see any greater movement in terms of market share or higher earnings growth over there?
Yeah, so when we bought Dr. Lal Pathlabs first into the portfolio, it was around 900 odd levels or so at that point in time. So now it's 2,400 or close to 2,500. It has gone up a bit over the last in this year as well, about 2% up or so. Last 1 or 2 months, it may have done better. But what we've seen is that we don't take these, and you would be aware, I'm sure, that we don't take calls based on near-term earnings trajectory or PE multiples. We have a slightly different framework of looking at stock valuations based on whatever the cash flows the companies generate over and above the cost of capital. So that is how we assess companies, that whatever is their cost of capital, basis that what is the sustainable cash flow which they can generate over a period of time. And in that regard, which is known as an OpCo-Finco framework, and in that framework, both Dr. Lal Pathlabs and Metropolis stands up. So there could be some near-term pressure to earnings as and when these predatory pricing things happen. But we have seen, as I said, these competitive pressures ease off, and we still hold these companies in our portfolio. Yeah.
So the question was regarding, like, when we are talking about India will become 5 trillion soon in by 2030, what are the sectors that are going to play a vital role, and which are the companies that can become bigger, is what I wanted to understand.
Oh, that's a very good question. There are already quite a few companies in India who are leaders in their respective segments. Or HDFC Bank, for example, you just take the banking sector. SBI, obviously, a behemoth in its own right. So so there are segments, there are sectors where things can scale up significantly more. IT services, already Indian companies are market leaders. Consumer discretionary, Indian companies, if you look at their comparables, versus versus what is the global comparable as far as size is concerned. Many consumer discretionary companies, for example, are global leaders as far as the capacities, as far as the annual production is concerned. So is the case with many of the cement companies. So many Indian companies are already world-class companies if you look at their size, if you look at it from a size, if you look at it from a capacity perspective. The only one thing which does not stack up somehow is, it has been generally the case for all emerging markets, generally the case for India as well, that despite being a growing part of the global GDP, they have not accounted for a growing part of the global market cap, right? So India is still 1.7, 1.8% of the global market cap, right? And a lot of it, and a lot of re-rating which you will see will happen across companies, because now in the top 100 companies globally, there are just 2 Indian companies, right? By MCAP, I'm talking about by market cap, not by revenues or sales or within their respective segments, by the turnover or by their capacity, right? So I'm just talking about by the market cap. So that ways, I'm sure that you will see many companies come through, which means that you will see maybe few more banks, few more. One or two auto companies, maybe across sectors you'll see a few other companies also be part of the stock markets, be part of the top 100 companies. There are new companies which might get listed as well, so there are many unlisted large companies in India right now which might get listed as well, so there can be a potential there as well. So you'll see it coming from a host of sectors. It is impossible to pinpoint at one particular company and say, look, that will be in the top 100. But you will, at least from an India perspective, what we feel is that our portfolio is very dynamic. It will continue to reflect the market leaders, the ones which were continuously gaining market share, and the ones which will continue to deliver on all operational fronts year after year consistently. So that is what I think one should focus on, and that is where you'll find our portfolio very handy to give a list of such companies.
Thank you.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.